So you think you can use your VA loan only once? Well, think again. You think you can have more than one VA loan at the same time? Yeah, you can. In fact, you can have multiple VA loans existing at the same time. There is no limit. I've helped thousands of active duty and veteran families buy another home using their VA loan without selling their current one. And I'm going to show you step by step how it works. First and foremost, you can have more than one VA loan at the same time. There's a little thing called entitlement. Your VA entitlement dictates how much you can use on your next VA loan. When you use your VA benefits, you are charged a certain amount of entitlement, and that charged entitlement equals 25% of the initial loan that you get. So for example, if you finance $100,000, your charged entitlement is going to be $25,000 and so on. And what the VA does is they look at what's called a maximum loan amount that you can use, and they factor in that charged entitlement to calculating your new loan. If you are curious about how much VA loan you can get, I do have a video on how to calculate your max VA loan, and the link will be in the description. So I highly recommend you check that one out if you're looking to use it again. But just safe to say, you can have more than one VA loan at any given time. In fact, you could have multiple VA loans. I have one client of mine who has 3 VA loans in place right now, and he still has enough entitlement in order for his next duty station that he can use his VA loan again. And yes, he'll have 4. I wonder what the world record is for a number of VA loans, but you know what? I'm going to set it. There you go. But here's what you need. In order to have another VA loan at the same time, there's a few things you need. First of all, you still must have remaining entitlement. In fact, the VA requires you to only have $1 of remaining entitlement. Now, there's a little trick with this. Let's just say you have your VA loan in place, and we've calculated how much you need, as far as down payment goes on the next house. And we're going to get into this a little bit where you can avoid the down payment requirements. But the VA still has a maximum loan amount calculation. Okay. So what you can do is you can withhold $1 of entitlement when you get your new VA loan. In other words, we're not going to use all of your entitlement on this purchase. So you bring an extra $1 to close, that frees up your eligibility for the next house. Now, the good news also is that typically the conforming loan limits are adjusted every single year upwards. Another thing to know about using your VA loan for the second time is that this other home must be a primary residence. So you can't just buy your primary residence and see this really pretty house in Florida that you want to buy and then use your VA benefits for that as a second home or an investment property. That's not going to work. It's got to be for a primary residence. And of course, in order to use your VA benefits, again, you've got to meet all the normal qualifying and debt to income requirements. Now, I'm going to caveat this by saying a lot of lenders get this wrong, especially when you're talking about a departing from one house and then buying another one. This is called departing seller or departing residence. And what a lot of lenders get wrong is that the VA has a very clear guidance on what they tell lenders to omit in your current financial position. Meaning, when you move from house A to house B, there's a payment on house A, right? You may be selling it or you may be renting it. What a lot of lenders overlook is they say, oh, well, you don't have any history renting out this current property, or we don't have a fully executed contract with no conditions on it, so we have to count that entire payment against you. That's actually wrong. Lenders are supposed to ignore this payment. In fact, if you're selling it, I could go into a lot of detail, but let's just safe to say is that the VA guidelines are very, very clear that a lender should not be counting this payment against you, especially if you're selling it. But if you're renting it, the VA allows you to do a what if scenario. Like, what happens if I were to rent it? And all you need to do is to get an appraiser to go out there and calculate what the expected rent would be on that property, or even just have your realtor say, hey, this home should rent for about $3,000 a month or whatever it is. And then you can use that money per month, multiply that by 75%, and then you can offset the current payment. Not to get into the weeds too much, but just keep that in mind. When you're moving from house A to house B, just make sure you're working with a lender that understands VA loans and that you do not have to count that full payment against you. And by the way, if any of this sounds confusing or a little bit, just reach out to your old buddy Rick, or even just put a comment in there, and I do respond to those. I want to go a little bit deeper into how the entitlement math works. Every eligible veteran starts with full entitlement. And up until recently, you had this weird calculation as to how much of a maximum VA loan you can get, but they actually blew the top off of that. If you have full entitlement, there is no cap to how large of a VA loan you can get with no money down. Now, certain lenders cap that amount, be it $2 million up to with an X amount of your credit scores, and all they're doing is pricing for risk. But it is safe to say that there is no cap on how big of a VA loan you can get. You just need to talk to your lender about what their specific rules are. When you use some of that entitlement on your first home, you still have a remaining entitlement. On your certificate of eligibility, you're going to see a box that says charged entitlement. They kind of outline it based on how many properties that you have and how much eligibility has been charged. That's the number you use to calculate your new VA loan. The math is pretty simple, but it does need to be exact. I've done spreadsheets about this that make the math a lot simpler, but it isn't really rocket science. What happens is every county has a maximum loan amount. So when you have eligibility that's been charged, you have to go by the formula. And part of that formula is the county loan limits. And again, if you plan on using it again and turning this property that you're buying into a rental, you'll want to make sure to retain at least $1 of entitlement. That'll set you up for the next one. Now, there are scenarios where you don't have enough money because of the entitlement that you have tied up. And this happens quite a bit. For example, I have a client who's buying in a high cost area and he's got some entitlement charged and he doesn't have a down payment, but he's trying to get this house. Now he qualifies really well. Now he qualifies really well from his debt to income ratios and whatnot, but he just doesn't have a bunch of cash. Now, there's a couple ways you can do this. Obviously, if you have the cash, you just make up the delta between the sales price and the maximum VA loan. However, a nice way to do this is to use what's called a home equity line of credit. You can do a first max VA loan minus $1, remember, plus a home equity line of credit up to 100% of the value of the house. This allows for no down payment. Now, I will warn you, most lenders will say, you can't do that. Look at all these rules. Look at this guideline that the VA says. It says that the second mortgage has got to be the same interest rate as the first mortgage, and it says it's got to be assumable. Well, all of that's wrong. I have seen a lot of buyers and have helped a lot of buyers get into their second VA loan with no money, even when they have entitlement charged against them. The last thing I want to talk about is the decision when you go to use your VA loan again. The big question is, do I keep it and rent the house or do I sell it? That's really your decision. However, I have seen many a military family build a lot of wealth by keeping homes, renting them out, and then selling them down the road. There's a couple of cool tax benefits by doing it this way. If you home, let's just say you buy a house in Northern Virginia and you live in it 3 years and you have to have a permanent change of station. Okay, you choose to rent it and rent in an area that is really strong. Then you get relocated to, I don't know, let's say Lejeune, whatever. Well, you're going to keep the home in Northern Virginia and you're going to rent it out. Because you've lived in that property as your primary residence for 3 years, you qualify for a lot of cool stuff. In fact, the current, I'm not an accountant, however, tax rules regards to how, if paying taxes on capital gains are only applicable if you have not had this been your primary residence at least 2 out of the last 5 years. So when you figure out doing the math of how long you want to hold on to that property before it becomes a true investment property, and you got to start thinking about 1031 exchange, stalker. I mean, just it's like a little bit of a nightmare because the pressure you have to, once you liquidate that house, then you have to buy another investment property in order not to get taxed on it. It's a little bit of a nightmare. So I like to kind of say, hey, let me keep onto this property until I am up against my 2 out of the last 5 years. It was my owner occupied residence, so I don't have to pay the capital gains taxes. It's a beautiful, beautiful thing. Now, tax laws may change, so consult your tax person and they'll give you the lowdown. But that's a neat strategy. So if you keep the home as a rental and then you buy the next house with your remaining entitlement, you let your tenants obviously pay the mortgage on the current home. Now, here's a little bit of a tip. If you bought right now, you'll be looking at interest rates that are higher than we've seen in the past, right? I think honestly, they're not historically high, but they are high. And I believe they're high. If they do come down during the time that you made this property a rental property, a lot of people think, oh, I can't refinance this thing because now it's an investment property, it has different rates. VA doesn't work that way. It doesn't matter if it's an investment property or a primary residence. You can use what's called your VA IRRRL, a streamlined refinance, to lower your interest rate, and there really is no hit to the interest rate at all. You get the same rate as if you were a primary residence. That's really it. Oh, one thing to mention, that if you do plan to sell the house eventually, one thing you cannot do with a VA loan is take the proceeds from the homes, any home that you sold, and pay down the mortgage and recast that loan of the house you just bought. Many people think, oh, well, I'm going to buy the new house, I'm going to finance 100%. When I sell the current home, I'm just going to put a big lump sum payment into this house and voila, my payment will go down. That's not how it works. There's no prepayment penalty on a VA loan, but if you prepay the house, you don't get the lower payment. That's called a recast, and typically you can only do that on conventional loans, not government loans. So should you sell, or should you use your benefits again and keep growing your real estate portfolio? Many people have been doing this. It's a real strategy. I love the idea of holding on to real estate and using your VA benefits to purchase again and again and again and again, leaving that beautiful VA loan in place, allowing yourself the flexibility to refinance should rates get lower, and you just have so many options that way. And again, if you buy with no money down, your return on investment is astronomical. If you have any questions or you need help figuring out if you're eligible or how much house you can buy, please drop me a comment, or you can email me at rick@loanwithrick.com. This is Rick Elmendorf, and I'll see you on the next video.